Good morning, everybody. This is Chris Robinson, Robinson Ag Marketing, with today's pre-opening grain and livestock comments. First of all, I don't care, who you're rooting for. That was a great, great game last night, and that quarterback for Indiana, amazing, amazing, great, great athletes on both sides. But that was a great game. All right, overnight, right? We were closed yesterday for the holiday. Corn, the 3 cent range, down 2 1/4 cent. March, about a 7 cent range. We're down 2.5 cents. Wheat's down 4 1/4 cents. Kansas City wheat's down 2 3/4 cent. We are going to be watching what we always watch now at this time of the year. How big is the crop going to be coming out of South America, and will China stay in the game? Um, purchasing our beans. It's really what it comes down to. We are looking at who to blame for the sell-off. Remember last week, corn really got hammered for the week, down 21 cents. Soybeans actually held in there pretty good. They were only down 4 3/4 cent, and while wheat actually hung in there and was flat. So I guess it could have been worse. How's that? But I think a lot of people listen to this podcast are farmers, and they're sitting on a lot of corn, and that continues to be the thorn in everybody's side. Um, I really can't blame the funds for this because they didn't have a big position at all going into the report. They did sell 65,000 contracts as of last Tuesday, so they did that between Monday's number and Tuesday's close. They were short 80,000, but they only had 15,000 on going into it, so I can't really say that they were responsible for this. Wheat, we stayed unchanged. They've been short 100,000 wheat for a while, and soybeans, they sold 45,000, but they went into the report long, so it kind of shoots holes in everybody's arguments that the funds are just out to get you. They're out to make money, and they're out to trade with the trend. They're out to, um, follow the rules of supply and demand as opposed to what somebody's promising to do. So if the numbers are wrong, guys, the market will reflect it. At the end of the day, there's no politician or organization out there that can lie good enough to cover up supply and demand. If the bushels are there, they'll show up. If they're not there, the price will reflect it, and we will reprice. And we can do it very, very quickly. I did the weekly wrap this week. If you didn't get my letter, please take a look at it. Call me, email me. I'll send it to you. Um, every weekend I spend about 3 or 4 hours breaking down longer term positions. And why does that matter? Because we're full of opinions. We're full of data, right? And then at the end of the day, it all comes down to the report card. The report card is the price. So that's why I focus so much on the prices. There is no perfect charting system. There is no perfect uh, trading system out there. It always requires you to do one of two things. First of all, you have to have a plan. Second of all, you have to execute the plan. And all those technical levels do is give you levels which attract buyers and sellers. It's like if you were sitting in a hunting stand, or you're going to go sit in the field where that only one deer comes by once a month. No, you're going to go pick a spot where there's a convergence or there's a target. So then you've got choices to make, and that's all these key levels, the retracements, the 100-day moving averages, the trend lines. They are just areas where everybody gets together and has an argument, and then we figure out what the price is afterwards. Most likely, though, when prices change violently, everybody that was wrong or that didn't hedge. It's human nature, right? You need somebody to blame, and the worst person you want to do is look at yourself in the mirror and say, "Gee, I could have done something and I didn't." And that's the real key to hedging is to maintain discipline, try to not be emotional, and recognize that you're in a business. And I was told when I showed up to the Board of Trade in 1990 that 7% of the people that showed up there made a living. And I tended to agree with that because I saw thousands of guys come in, smart PhDs or people with high school educations. It didn't really matter who the best traders were. It was lots of times an innate skill. That's why they write books about them. You can go read those books, Heavy Hitters, Market Wizards. Out of the millions of people out there, there are people that do have a gift, and in my experience, they do not work with farmers. They do not work. They do their once they start making a lot of money, they become private people and really don't talk to a whole lot of people. And so they're few and far between. The rest of us, what we can do is do the homework, set the hedge, and look for the best opportunities to make cash sales. The number one problem or issue with marketing is that statistics show that two-thirds of all the grain ends up getting marketed in the bottom third of prices. Don't have to take my word for it. You can look it up out there. I'm not making it up. So if you can get in the middle or the upper third, you're doing better than two-thirds, 75% of the people out there. And that is what I'd say every marketing advisor recognizes. That's what we're trying to do. And at the end, I decided this: what matters is not what you do in your hedge account; it's where you make your cash sales. So my whole program is about making good cash sales, staying in position, making good cash sales, not getting locked up in ideas, not trying to handhold everybody into telling them, promising them it's going to be all right. I don't know if it's going to be all right, and neither do you. But I do know that right now we can protect these prices. And that's what I would do. And the second thing I would say is if you look at my letter, long term, there's some 22, 25-year-old trend lines out there that are down at the bottom under these markets. Are we going to dive back down to them? I don't know. I sure hope not. But I think it's a mistake to pretend like it's not a possibility. And where I run into a problem is people don't listen closely. When I say there's a possibility there, some guys are like, "Oh, you're promising me there that so I should just sow my whole crop." Rah, rah, rah. No, that's nonsense. What I would say is, if you know there's 50 cents worth of risk, is it worth spending 5 or 6 cents on a put? And then you can decide, whether or not you do that. Same thing with the beans. There's $1 worth of risk if things go sideways this year. Is it worth having a hedge on? Only you can decide. And I'll tell you this: it was nice to have puts on, especially for corn, in front of that last report. We had no idea we were going to break, 25, 30 cents. Nobody knew that. But the guys that were hedged, right? And I can tell you this: for all the guys that had spent 4 or 5 cents on options with me, or maybe up to 8 cents if they went out to March, if corn had been 30 higher, they would have told me, "Don't ever call me again about puts. Puts don't work. I don't need puts." So, all right, that's my 2 cents about marketing this morning. Have a great rest of the week. This is Chris Robinson, Robinson Ag Marketing. If you're looking for help, you may call 312 638 8868.